Tariffs, tariffs, tariffs. The headlines do more to terrify than to clarify. Let's go ahead and unpack that. Hey everyone, this is Zaid Hanna with the Hanna Group here at Real Estate 38, and I started with the headlines do more to terrify than to clarify. As you have seen in the past couple of weeks, we are in tariff wars yet again, déjà vu, 2018. So what is that doing to our market here in the real estate? Well, our Bay Area real estate market is controlled heavily by the stock market, financial market. A lot of our buyers, they get paid with salary and they get paid with restricted stock options, RSUs. So when those RSUs drop, like Apple dropped by 30%, Nvidia, Broadcom, and I can go with all the Magnificent Seven stocks that did drop, well, that down payment has been wiped off a little bit. So during that period of time, when that dropped, there's a little bit of pause in the real estate market here. However, are we crashing? No. Let's go through the data. Let me give you important information so you can actually make an educated decision, because there are some opportunities to be had. And in fact, in the past just 2 weeks, we have had some amazing deals for our buyers. So let's go ahead and unpack that. We'll start here with the first graph to show you that we have about 17% nationally. We're more than that. We're about 50-60% more inventory here in the Bay Area than we were a year ago. Now, mind you, a year ago, it is the lowest since the early 90s. It was in the articles, it was in the headline news to say we barely had any inventory. So now we actually have a healthy amount of inventory. We have about 1,000 actives here in San Jose. Now, if you see in this graph that we are just about in the middle, we're just recovering from the COVID times of inventory, very low levels. We're not quite before 2018, as you could see in the top graphs, but we're about in the middle in terms of the amount of inventory. That's a healthy market. So is this screaming, oh my gosh, price drops? No, it's screaming we're going to go into a healthy market so you as a buyer have better options. Now, what's interesting about our sellers, especially in the Bay Area here, if you see in this graph, to say Americans are sitting on massive equity. 68% of Americans have either paid off their home cash or have 50% or more of equity into their home. I'll say that differently. If an average price point in San Jose here is about $1.5, $1.6 million, that is all paid in full, or homeowners have at least 800 or higher in equity into their home. So if the price fluctuates, you think that seller is going to sell? No. Oh, by the way, the other, we can call it just about 30% have 50% or less equity. That's still 20 to 50% of equity. That's still a lot of money where homeowners have a lot of equity into their home. So what I mean by that, in 2022, when prices started to fall because interest rates went from 2.5 to 6.5, sellers said, if I don't get that price, I am not a seller. I'm taking my property off the market. I'll just go ahead and rent it because my mortgage rate is so low on the property. So sellers will not allow that property to sell below where it actually should sell at in regards to the comparables. However, what we're seeing though, we're seeing a slightly amount of inventory due to the panic sellers that are just listing their properties thinking that we are going to crash. Don't do that. You're actually not helping yourself. You're just adding more inventory when it really shouldn't be added. You don't have disclosures. You don't have inspections. The property's not ready. Don't list your home yet. Don't panic. We are going to normalize. So there's some massive equity in a lot of our sellers' homes, and they don't have to sell. They want to sell because they want to move somewhere else. So this is not a financial issue. So there's been a lot of talks in this graph here that recession is coming. Okay, well, when we were tariff wars, now this is on hold for about 90 days. We're trying to figure things out right now. But they said, well, most likely, almost 20% likelihood of a recession. It was low 15, now it's 20. It went up to 35, now it's dropped back again. What drama in this market. So, okay, a recession should come. Should it come? And if it's going to come, if you see in this graph here, recession doesn't mean drop in home prices. Here's why. When recessions come, what we see here in the other graph, it means fallen interest rates, not falling prices. When interest rates drop, it makes the monthly payment a lot cheaper. here in the Bay Area, we have a lot of employed people. Yes, we are seeing layoffs, but a lot of people have employment is only 5% here in California. So it's still very, very historically low. So when we look at recession, and let's say recession is coming, that is actually good for home prices because mortgage rates drop. Therefore, buyers enter the market where they drive the prices up. So let's talk about the opportunity. Right now, the first quarter of 2025, we went up in pricing by about 10%. Now, mind you, Florida, Texas, South Carolina, heck, even Tracy, prices did drop the first quarter of 2025. But what did we do in the Bay Area? We went up 10%. Now, I predicted beginning of the year, we are going to go up and we're going to give those gains back because we're going to see an increased amount of inventory. Yes, we predict that. You can go back to the video for the first week of January when we said we're going to see more inventory. That's going to normalize the prices, and we're going to end the year with maybe 2 to 3 to 4%. I still hold to that, by the way. So as we look at that to say, if you're a buyer, get in. This opportunity is great for you not to compete with 30 other buyers, for you not to overpay by $200,000. Just today, I'm negotiating a deal where the seller had listed a home for $3.1 million, and we're about to go in contract for 2.8, 300,000 below that number from 6 months ago. So if you want to get an opportunity, you want to enter the market, we will be here for you. Feel free to reach out, 408-515-1613. Bye-bye now.